Imagine opening your investment account after years of hard work and seeing one number staring back at you: $100,000. For most people, that moment feels like crossing the finish line. You finally made it. The late nights, the skipped vacations, the automatic transfers into your retirement account, it all paid off. But here's something that rarely gets talked about. Reaching your first $100,000 isn't the finish line. It's the moment your financial life changes forever. Because before six figures, your paycheck is doing almost all of the heavy lifting. After six figures, your investments finally begin working alongside you. And the decision you make during the next 12 months can have a bigger impact on your future wealth than the previous 10 years combined. Today, we're breaking down exactly what financially successful people do after reaching their first $100,000 and the costly mistakes that quietly keep everyone else stuck. Let's get started. There are two different ways to build wealth. The first is through effort. You go to work, earn a paycheck, save part of it, and invest what's left over. This stage requires discipline, because every dollar invested comes directly from money you could have spent today. But eventually something interesting happens. Your investments begin earning their own money. If you have $100,000 invested and earn an average annual return of around 8%, that's roughly $8,000 of growth in a typical year. You didn't work overtime for it. You didn't ask your boss for a raise. Your money generated more money. That's the moment everything changes. Instead of relying on one income source, you now have a second engine quietly building wealth in the background. It's not guaranteed every year. Markets go up and down. But over long periods, history has shown that disciplined investors who stay invested have generally been rewarded. The problem is that many people reach this milestone and unknowingly interrupt the process. Not because they're careless, because the mistakes often feel completely reasonable. Let's look at the first one. The first mistake is believing that a bigger bank balance means it's time for a bigger lifestyle. It usually doesn't happen all at once. Nobody wakes up and decides to double their spending overnight. Instead, it starts with small upgrades. A newer SUV because you've earned it. A luxury apartment because your income can handle it. More expensive restaurants. Premium subscriptions, weekend trips that become regular habits. Each decision feels small, but together they create a new monthly budget that's much harder to maintain. Imagine someone who increases their monthly spending by just $900 after reaching six figures. That sounds manageable, but over a year, that's more than $10,000 that never gets invested. Now imagine repeating that every year for 20 years. The opportunity cost becomes enormous. Not because those purchases were bad, but because every dollar spent today loses decades of potential compound growth. This doesn't mean you should never enjoy your success. Quite the opposite. Money should improve your life. The key is spending intentionally instead of automatically. Buy the things that genuinely make your life better. Avoid spending simply because your account balance makes you feel richer. Real wealth isn't measured by how expensive your lifestyle looks. It's measured by how much freedom your investments create over time. Now let's talk about another mistake that catches even experienced investors: overconfidence. Building your first $100,000 takes years of consistency. After years of success, it's easy to believe you've figured everything out. That's when people start thinking they can outperform the market. Instead of staying invested in diversified index funds, they begin chasing the next big opportunity. A trending technology stock, a cryptocurrency everyone is talking about, a friend with an inside opportunity, or options trading that promises fast profits. Sometimes these investments work for a while, and that's exactly what makes them dangerous. Early success often creates even more confidence, until the market reminds everyone that risk works both ways. The same investment that rises 30% can fall 40%. And recovering from large losses is much harder than most people realize. A portfolio that drops 50% doesn't need a 50% gain to recover. It needs a 100% gain just to get back where it started. That's why experienced investors protect their foundation first. If you enjoy taking risks, consider setting aside a very small percentage of your portfolio as fun money. Maybe 5%. If those investments succeed, great. If they fail, your long-term future stays intact. The core of your wealth should continue doing what built it in the first place: steady investing, low costs, broad diversification, and patience. Because patience is often the highest-paying investment skill anyone can develop. Here's another lesson that surprises many people. Building wealth is rarely about making brilliant financial decisions. More often, it's about avoiding catastrophic ones. You don't need to predict the next winning stock. You don't need perfect timing. You don't need to check financial news every hour. You simply need a system that keeps working, whether markets are exciting or boring. That's why automation is so powerful. Set up automatic investments every payday. Increase your contribution slightly whenever you receive a raise. Remove emotion from the process. The fewer financial decisions you have to make every month, the more consistent your investing becomes. Consistency beats intensity almost every time. There's another psychological challenge that appears right after 6 figures. For years, your goal was clear: reach $100,000. Then one day you do, and suddenly, the target disappears. Without realizing it, many people lose motivation. Saving no longer feels exciting because they already accomplished what they spent years chasing. That's why successful investors always create the next milestone before celebrating the previous one. Maybe it's $250,000. Maybe it's $500,000. Maybe it's financial independence. The exact number doesn't matter. Having a new destination keeps your habits moving in the right direction. Because wealth isn't built through one big achievement. It's built through thousands of ordinary decisions repeated over decades. And that's exactly where the biggest advantage begins. One of the biggest questions investors ask is simple: which one actually makes more money over time, ETFs or individual stocks? The honest answer is that it depends. If you pick one of the world's greatest companies early, an individual stock can outperform almost any ETF. Companies like Apple, Microsoft, Amazon, and Nvidia have delivered extraordinary long-term returns for investors who bought early and held through years of growth. But here's the problem. No one knows today which company will become the next long-term winner. For every stock that becomes a success story, many others underperform the market or even disappear entirely. That's why relying on a single company can be risky. Broad market ETFs work differently. Instead of trying to predict the next winner, they own many of the winners automatically. As companies grow and become larger parts of the market, they naturally become larger holdings inside many index ETFs. At the same time, companies that decline gradually represent a smaller portion of the fund. This automatic adjustment is one reason index investing has become so popular. Now let's talk about costs. When you buy an individual stock, many brokers today charge no commission for standard U.S. stock trades. However, you still need to spend time researching companies, monitoring earnings, and deciding when to buy or sell. ETFs usually charge an annual expense ratio. For many broad index ETFs, that fee is very low, often just a few hundredths of a percent each year. While the fee slightly reduces returns, many investors consider it worthwhile because they receive instant diversification and professional index management. Next comes taxes. Taxes vary depending on your country, account type, and personal situation. So it's important to understand the rules that apply to you or consult a qualified tax professional. In general, long-term investing often results in fewer taxable events than frequent trading. Investors who constantly buy and sell individual stocks may create more taxable transactions, while long-term buy-and-hold strategies can be more tax-efficient in many situations. Now let's discuss dividends. Some companies share part of their profits with shareholders through regular dividend payments. When you own a dividend-paying stock, you receive dividends only from that company. Dividend ETFs are different. They hold many dividend-paying companies. So instead of relying on one business to continue paying dividends, your income comes from multiple companies across different industries. For investors seeking more consistent dividend income, diversified dividend ETFs can reduce the impact if one company cuts or suspends its dividend. Let's talk about emotions. This is where many investors lose money. Imagine one of your stocks drops 25% in a week. Fear takes over. You start wondering whether you made a mistake. Then panic selling begins. The opposite also happens. A stock rises quickly, excitement takes over, and investors buy after prices have already surged. Successful investing requires controlling emotions, and that's often easier with diversified ETFs because your portfolio is less dependent on the daily movement of a single company. Now let's answer the most important question. What do smart investors actually choose? Many experienced investors don't see this as an either-or decision. Instead, they combine both. A common strategy is to build the foundation of a portfolio with diversified ETFs, then allocate a smaller portion to carefully selected individual stocks. For example, someone might keep most of their portfolio in a broad U.S. market ETF while using a smaller percentage for companies they have researched and strongly believe in. This approach aims to balance stability with the opportunity for higher returns. Before you decide what to buy, ask yourself 3 simple questions. How much time am I willing to spend researching investments? Can I stay calm when markets become volatile? Am I investing for the next 6 months or the next 20 years? Your answers matter more than trying to find the perfect investment. For many beginners, broad market ETFs provide a simple way to start investing while learning how markets work. As experience grows, some investors gradually add individual stocks to complement their diversified portfolio. The key lesson is this: building wealth is rarely about finding one perfect investment. It's about investing consistently, managing risk, staying patient, and allowing compounding to work over many years. The investors who succeed aren't usually the ones chasing every market headline. They're the ones following a disciplined plan through both good markets and bad. If today's video helped you better understand the difference between ETFs and stocks, make sure to like the video, subscribe to the channel, and share it with someone who wants to become a smarter investor. Thanks for watching, and I'll see you in the next video.